Time is running out, and I don't say that for drama, I say it because the window most investors wait years for is closing right now, quietly, while distractions are everywhere, the headlines are confusing, and the majority of people are still frozen, waiting for a perfect signal that will never come. History shows that the biggest money is not made when everyone feels safe, it's made when uncertainty is high, conviction is low, and patience is rare. That is exactly where we are today, and if you miss this phase, you may spend the next decade chasing returns that were available right now. Let's start with the big picture, because smart investing always begins with context. Markets move in cycles, fear and greed rotate, liquidity expands and contracts, and every major wealth-building opportunity sits inside a moment when most people hesitate. Right now, we are standing in a transition phase, not a crash, not a boom, but the calm before a powerful shift. Institutions are positioning, insiders are accumulating, and long-term capital is quietly flowing into assets most retail investors are still ignoring or doubting. The first thing you need to understand is that uncertainty is not the enemy of investors, uncertainty is the discount. When people feel confident, prices are high. When people feel confused, prices are reasonable. And when people feel scared, prices are cheap. Look around. Inflation headlines, interest rate debates, geopolitical noise, AI disruption, recession fears, all of this creates hesitation. But markets don't wait for clarity, markets move ahead of clarity. One of the biggest mistakes investors make is waiting for confirmation from the news. By the time headlines turn positive, the opportunity is already gone. The market doesn't ring a bell at the bottom, and it doesn't send a warning before the rally begins. The early phase always feels uncomfortable. It always feels like it's too risky, too uncertain, too early. That discomfort is exactly why the opportunity exists. Now let's talk about money flow, because price follows liquidity, not opinions. Central banks around the world have already shifted tone, even if actions lag behind words. The era of extreme tightening is ending, and the market knows it. Whether it's 6 months or 12 months, capital is forward-looking. Big money doesn't wait for the first rate cut, it positions before it. This is why you're seeing quiet strength in quality assets while sentiment remains mixed. Historically, some of the strongest multi-year rallies begin before the first official policy pivot. That's not speculation, that's data. The market starts moving when conditions stop getting worse, not when they become perfect. Right now, conditions are no longer deteriorating at the speed they were before, and that matters more than most people realize. Another critical factor is valuation. While certain hype-driven assets already look expensive, many fundamentally strong companies are still trading below their historical valuation ranges. Not because they are broken, but because fear compressed multiples. This is how long-term investors win, by buying strong businesses when their prices reflect pessimism rather than reality. Look at how major indices behave during these phases. The S&P 500 doesn't explode upward overnight. It builds a base, frustrates traders, shakes out weak hands, and then moves when most people least expect it. Sideways markets are not boring, they are preparation zones. They transfer shares from impatient investors to patient ones. Technology is another area where time is running out. We are not at the beginning of innovation, but we are at the beginning of monetization. Artificial intelligence, automation, cloud infrastructure, and data analytics are no longer future concepts, they are current revenue drivers. The companies leading this shift are not science experiments, they are cash-generating machines with expanding margins. Take leaders in semiconductors, cloud computing, and AI infrastructure. Companies like NVIDIA are not just riding hype, they are supplying the backbone of a new digital economy. When demand outpaces supply in critical technology, pricing power increases, and long-term earnings follow. Missing the early accumulation phase often means buying much higher later, when everyone finally agrees the future has arrived. But this opportunity is not only about tech. Defensive sectors, dividend payers, energy, and infrastructure are also positioning for the next cycle. Smart investors don't go all in on one theme, they build balanced exposure before the crowd shows up. Diversification during uncertainty is not weakness, it's strategy. Now let's address the emotional side, because investing is more psychological than analytical. Most people know what they should do, but emotions stop them. Fear of being wrong, fear of short-term losses, fear of missing something better later. Ironically, Fear of missing out often causes people to miss the real opportunity, because they wait until it feels safe. Ask yourself this honestly: do you want to feel comfortable now, or successful later? Comfort comes from doing what everyone else is doing. Success comes from acting before consensus. Every legendary investor faced periods where their decisions looked questionable in the short term. The difference is they understood time, not timing. Time in the market beats timing the market, but only if you enter during periods of doubt, not euphoria. This is where long-term wealth is built, slowly at first, then suddenly. Compounding doesn't announce itself, it sneaks up on those who stay consistent. Another overlooked signal is insider behavior. While retail investors are debating headlines, executives and institutions are quietly accumulating shares. Insiders don't buy for excitement, they buy for value. They understand their businesses better than any analyst or influencer ever will. When insider buying increases during uncertain markets, it's rarely random. Liquidity on the sidelines is massive. Trillions of dollars are sitting in cash and money market funds, earning temporary yield but waiting for direction. When confidence returns, even slightly, that money will move fast. Markets don't gradually adjust to that kind of capital, they reprice aggressively. This is why time is running out. Not because tomorrow is the last day, but because the best prices don't stay available forever. The longer you wait, the smaller your margin of safety becomes. Early investors buy value, late investors buy narratives. Let's talk about strategy, because action without a plan is just gambling. This is not about betting everything on one stock or one idea. This is about building positions gradually, focusing on quality, and thinking in years, not weeks. Dollar cost averaging during uncertain periods reduces emotional pressure and improves long-term results. Focus on companies with strong balance sheets, consistent cash flow, pricing power, and long-term relevance. Avoid chasing hype spikes. Avoid panic selling on red days. Volatility is not a signal to exit, it's the price you pay for long-term returns. Remember, markets reward patience, not perfection. You don't need to catch the exact bottom. You just need to avoid missing the move. The biggest regret investors share is not losing money, it's not investing when they had the chance. Think back to previous cycles. People hesitated during the aftermath of crises, doubted recoveries, and waited for certainty. Those who acted early didn't look smart at first, but years later, the results spoke for themselves. Wealth is built quietly, not loudly. Even today, many investors are still anchored to past prices. They want things to go lower, they want a clear signal, they want zero risk. But zero risk doesn't exist in markets. There is only managed risk and missed opportunity. The truth is simple but uncomfortable. If you wait until everyone agrees it's safe, you will pay a premium. If you act,